Good morning once again. Well, the SGX Nifty for now is indicating a pause, perhaps an early morning trade. No surprises there because the US markets have been down for 4 straight days. And give and take everything, the week has been quite, bad for the bulls. The S&P 500 is down almost 5% this week. This morning, the Asian markets are also under a bit of pressure. But let's see, Nikkei is down almost, I think, 500 points or so. The Japanese market was shut for trade yesterday, so do keep an eye out on that. But moving on. India's largest mortgage lender, HDFC, has beaten street estimates in the second quarter, also reported best asset quality in the last 11 quarters. So that's a big cue to watch. Abhishek Kothari, my colleague, caught up with Keki Mistry, the Vice Chairman and CEO of HDFC, and began by asking him about the quarter gone by and his outlook on the operational performance. Take a look.
All right, so first of all, the growth momentum, which we've been seeing now for nearly 7 or 8 quarters, has continued unabated. We had the highest individual AUM growth during this period. Our individual AUM grew by 20% on a very large base, which is the highest growth we have seen in the last 8 years. And the momentum is strong, continues to remain strong. The feel-good factor in the economy is very high at the moment, and we are seeing growth coming both from the metros, the Mumbais, the Delhis, the Bangalores, the Punes, but we are also seeing equally strong growth coming from the Tier 2 and the Tier 3 towns. As far as asset quality issues are concerned, during that COVID period, there was some impact on asset quality for the entire financial sector. But I think the last few months, the economic growth in India, the feel-good factor in India is so strong. There have been hardly any job losses. People have got back there. Companies have started paying salary increases and stuff like that. So the feel-good factor is very strong. And therefore, the collection efficiency that we've seen on individual loans throughout the quarter has been well over 99%. And it's even higher in some periods compared to what it used to be pre-COVID. So collection efficiency is strong. Asset quality is improving quarter after quarter. Our total stage 2 plus stage 3 loans has come down consistently every quarter. Our credit costs have also started coming down quarter after quarter. And if you were to look at the gross non-performing loan number, that has also come down under the new method, under the RBI new method of calculation. It is now 91 basis points for individual loans, and under the old method, it is 73 basis points of non-performing.
Well, sir, we are in a rising interest rate scenario. As per you, how much of rate hike can be absorbed by customers without impacting both the loan growth as well as the asset quality?
See, over the years, if I was to look back at the last 15 years or more, interest rates in India have gone up and interest rates have come down. You take the example of 2008-9, take the example of 2013, 2018, and many, many points of time in history when rates have gone up very sharply. Our experience is that whilst there is obviously some impact on consumer sentiment when rates go up, it does not have that significant an impact on demand. For the simple reason that a housing loan is a 15-year loan, even though the duration is shorter. And because it's a 15-year loan and customers only get floating rate loan products, it really does not make so much difference where interest rates are at the point of time when you take a loan. Because if you take a loan when rates are low, they will become higher. If you take a loan when rates are high, they will come lower. So therefore, it has a much greater impact on short-term loans like a personal loan or a consumer loan or something like that, but a much lesser, a much more muted impact on demand for housing loans. So housing loan demand continues to remain strong, and historically we've seen periods of time when interest rates on housing loans have been 9% or even a little higher than 9%. So I would expect the growth momentum to continue.
Well, so one of the segments that is seeing growth across many other players is the loan against property as well as the lease rental discounting. What is your view on the same with respect to how are you seeing the industry trend or, the trend that is happening in your portfolio?
So consistently over the last several years, we have always said that we do our loans against properties much more slowly than what our growth in the loan against property segment is a lot lower than our growth on individual business. So we've never really focused in a very big way on loans against properties. LAP loans, as we call them, would typically be about 4% of our lending. So it's not a very large component. Lease rental discounting is a strong component of our lending. Lease rental discounting historically has been in the vicinity of between 6 to 7% of our total loan book. As the book keeps expanding, even the lease rental discounting loans keep expanding.
Another segment that I want to touch upon is the self-employed category. Are you witnessing any competition over there with dominant players in those particular geographies or those particular markets?
So let me tell you, competition is always there. Competition has been there for years and will continue to be there for years. But the fact of the matter is that all the competitors in the market, everyone in the market, sees that the growth opportunities are huge, and therefore no one needs to do anything which is irrational or anything which will be disruptive to the market as a whole. And that is reflected in the fact that we have consistently grown at a pace which is faster than the pace at which the market has grown. So, for example, if we look at this September period, our individual home loans on an AUM basis grew 20%, whereas housing loans in the banking system, if I recall right, grew by about 16%. So we grew at a rate which is about 3.5% to 4% faster than the banks. And if you track this for the last 8 quarters, you will see that consistently we have grown at a rate which is anything between 1% to 4% higher than the rate at which the system has grown.
So what is the outlook on demand and loan growth ahead for your company as well, the demand in housing finance sector, and how do you see the growth ahead for yourself?
So I think the structural demand for housing in India will always remain strong. We are a young population. More and more people are getting to an age where they will need a house. So it's a necessity. It's a need. It's not just an investment people make. So penetration levels are low, young population, affordability is still very good. So all these factors will contribute to growth. So I would expect that the growth momentum will sustain, will continue in the coming quarters. And as I mentioned earlier, if you look at the last 7 or 8 quarters, you will see consistently that we have grown at a pace which is faster than the growth of housing loans in the system. And I would expect that that momentum, that improvement or that increase in market share will continue unabated.
All right, that's the management of HDFC. Then Mr. Mistry, not mincing his words, they're sounding reasonably optimistic, actually. Well, Deven Choksi of KR Choksi joins in. Hi, Deven. Good morning. It's a Friday morning. Well, let's talk about a couple of numbers there. HDFC, we just heard out the management. What's your view